So I'm looking at the market setup for how we ended the week last week, and we were ending on a bull flag, but the move got a lot weaker. We had a lot of touches outside of this price cloud, and I think that there needs to be like a 50% retracement here, which is what I've been waiting for. I do happen to think that the market will probably keep going in the long term, up until it hits this resistance. This descending resistance line that I have here is part of that megaphone pattern that I've been watching the SPY. Like this is the megaphone that the SPY is going to trade in for the duration of this crash until we hit the capitulation. And there's a lot of concerning signs, like what Persephone is pointing out with the 3-month inverting the 2-year yield. For those that don't track bonds, that is an important figure. The 3-month yield, if this gets above the 2-year yield, then that is an inversion. And a 3-month yield inverting over the 2-year is a really bad sign of market volatility, and it also indicates a massive sell-off in the T-bills market. And a huge sell-off in the T-bills market will decimate the collateral for basically the entire banking sector and all of the investment firms that rely on it. For example, we just had FTX go bust. This is going to have devastating consequences for everybody, and most of the banking sector is probably scared shitless right now. So even what's that, Phil?
For squeeze plays, I imagine now a lot of them may come alive.
That is kind of what I'm thinking. Right now, the market is very supportive of squeeze plays because it's pushing the value of everything up. But when FTX fully collapses and the bankruptcy courts start seizing and selling all the assets at whatever they can get for it, that's going to cause massive ripples in the market that push everything else down, especially in the large cap. What I'm worried about is that a collapse in the crypto space, which is inevitably going to happen as a result of this. So if you're in crypto, this is your sign that things are about to get really chaotic and dangerous. The FTX collapse, this is just the start. The fact that we dropped from 20,000 to 16,000, that's not the end of it. Like Bitcoin can completely drop past 8,000. This will have massive consequences for the entire market.
Yeah.
So what I'm concerned about, though, is because you have other exchanges that collateralize their crypto with T-bills, if you simultaneously take away the value of crypto and the value of their T-bills, which act as collateral for all of their leverage, becomes less valuable, then simultaneously they lose the value in their leverage asset and they are losing value of their collateral asset that backs that leverage. So it creates more leverage. It actually exponentiates the problem. And that can cause a huge wave, like dominoes, of institutions failing because one big one has completely collapsed because they're so big that it caused all of the assets that are being sold forcefully into the market, causing the price to drop, damages all of their portfolios so bad. And to Persephone's point of rehypothecation, this is something that is well documented and known by the Fed that banks rehypothecate, or they sell a daisy chain of the same T-bill over and over and over again to each other. So they will lend and sell and lend and sell and lend and sell the same T-bill multiple times into the market. If you do happen to have the paper that goes into that, Persephone, I'd appreciate the paper from the Fed that actually describes that, and then we can share it with this group so that people can read it on their own time. But that is the problem that I worry that we're about to face, is that because the crypto space has become so dangerous and volatile with FTX collapsing, this is inevitably going to create a big wave of selling in the crypto market. It's going to hurt everybody. And the problem is that if this happens at the same time as those T-bills becoming so worthless, then it can cause everything to collapse. You'll have people selling crypto and then scrambling to sell their T-bills, and they're going to try and go and find the T-bills that they lent out to people who are not going to have them because they are trying to sell them themselves because they lent them out to someone else. And there's this huge daisy chain of institutions that have been repeatedly lending their T-bill. And you might have a T-bill that's been lent out 5, 6, 7, 8, 10 times. That's how bad it can get. And if any one of those institutions fails in between, then everybody that is still waiting on that T-bill to be returned to them loses everything that was attached to it. The collateral is just gone.
This the old synthetic CDO scenario?
It's not quite that. Synthetic CDOs by themselves,
it has the effects.
It has a similar effect. Yes, I would say it has a similar effect. CDOs that's like packaging bad assets together and then calling them good, and then repackaging that huge package of bad assets that you call good into better. And it increases the face value, air quotes, of the asset, but really the underlying asset is worthless. And that was just outright fraud. With this situation, the rehypothecation of T-bills is a basic functioning of our market that's been there for years. It's legal. I wouldn't even necessarily call it fraud. I would call it irresponsible, because the institutions require this liquidity to exist for there to be collateral in the market. But when they allow it to get this far and one institution behaves irresponsibly, that creates counterparty risk that then extends that counterparty risk to everybody in the chain who is not aware of who has been lent those T-bills. And that is the problem. Realistically, yes, you should just have the one lent out to somebody else, and there should be a tracking system, but there's functionally no way to do it. And even if it were done electronically, I think that the institutions would be really resistant to go along with it. But the long and short of it is that inevitably this will catch up on them. There are serial numbers. There are serial numbers attached to the T-bills, yes, but the way the lending system works is that, like, for example, overnight repurchase agreements. This is the overnight repurchase agreement for Treasury bills market for the Fed. This is the daily deposits of cash at the Fed, which are then exchanged for T-bills. So a bank deposits money at the Fed gives them a T-bill, and and that institution gets like a small percent of interest. This is a very necessary part of our market, but what the problem is that this has gotten so ridiculously out of hand, it ballooned to such an enormous size that the drawdown potential for this could cause collapsing. This could collapse even the biggest banks. There's so much money tied up in this market because everybody is using the T-bills that the Federal Reserve has issued out in exchange for this cash that they're holding for the banks. And now the banks are having this problem of, if all of those T-bills just suddenly become worthless because everybody's trying to sell them too quickly, then they can't get their cash back. They can't get the treasury because they have to return a treasury. It doesn't have to be the same treasury, but it does have to be one of equivalent face value. And it does have to be for the same maturity period. So they do have to return an equivalent treasury. It doesn't have to be the exact same serial number, but it does have to be an equivalent. And if they can't return an equivalent because the face value of them has declined so much that they can't go get them back, then then this money just gets sucked up into the Fed and they hold it indefinitely. They surrender the rights to this money and all of it stays at the Fed permanently. And the bank is just shit out of luck. So think about $2.2 trillion parked at the Federal Reserve that is sitting there because the banks put it there, needing those treasuries to act as collateral for all of these different leveraged assets. And then suddenly they find out that the value of their assets that were leveraged have completely collapsed. So now they can't sell them to go and get money back. And then simultaneously, the collateral they were using as a safety net to protect them from that downside risk are now also worthless. And everybody else is trying desperately to get their hands on them because they are scrambling to replace their lost collateral too. And you have this frenzy of institutions fighting over the same asset so that they can get their money back from the Fed. This is the disaster that I feel is just around the corner.
Thinking in general, all these things, all the markets are pointing to the same thing: a shrinking of liquidity.
Yeah, we are
It's a
seeing
wicked
a shrinking of
combination.
liquidity.
I don't know if we've ever had that in history aside from like the Great Depression.
2018 it
2008,
happened. The specific circumstance of the loss of liquidity that I'm speaking of is when there's a sudden freezing of those assets being traded in the overnight repurchase system. And that's what caused this crash to happen in 2018. This was because the Fed stopped the overnight repurchase agreement system. They turned it off as a part of their efforts to stop the to stop or to try to draw down their balance sheet, because the Fed balance sheet was still like ridiculous at this time. They were trying to they were trying different things in order to get their balance sheet down and go back into quantitative tightening, and they turned off the repurchase agreement system temporarily in order to reduce market liquidity, and it ended up causing a massive panic. And the whole market crashed, and you saw this 105-day period where the market we had a mini bear market that lasted only for like 1 quarter, but was just it was such heavy panic.
No, I think we're talking to them. I was just adding to what you're saying in general that this like we're in,
we have a whole bunch of additional factors of the housing market and
storm.
Yeah, it is. I would agree with that. Yeah, we do seem to be in the perfect cacophony of disastrous circumstances that could lead to like the entirety of our financial system imploding between housing and stocks, equities, crypto, all simultaneously going worthless, and treasuries that would basically collapse the financial system globally. Way worse than 2008. That is the fear.
Yeah. I would agree with that. As hard as it is to believe, I would agree with that.
When the Fed turns that spigot off, that's basically the spigot that it uses to basically provide liquidity to the economy when it locks up for other reasons, right?
Yes, 100% correct.
Okay, thanks.
Yeah. Yeah, when that Rapunzel system is shut off, that's basically turning off the money printer.